Hello, my name is Elliott. I'm editor of Personal Finance and the Energy Strategist. I want to take a look at and talk a little bit about the general market right now. Obviously, it's been a very volatile and confusing time, I think, for a lot of investors. The S&P 500 topped out in late April, trended down through most of May, kind of found a low in late May around 1045. 1045 on the S&P is the February 2010 low and was considered a key support point on the chart that a lot of traders look at. The high end of the trading range had been about 1105 or 1108, which is where the 200-day moving average is on the S&P. But recently, actually, we've poked above that. And so it does look like there could be a little bit of upside for the S&P 500 short term. But let's talk a little bit about exactly what's going on. What are the fundamental drivers of this sort of range-bound type of trading action we've seen? Obviously, one of them is Europe. The European credit crunch, at least as it applies to Southern Europe and the periphery of Europe, is ongoing. But the key thing to look at here is that, again, I think the media has sort of taken this and blown it a little bit out of proportion. There's been a lot of comparisons made between the current situation and the situation back in 2008 with the global financial meltdown, the interbank market completely closing down. There really isn't that much of a comparison whatsoever to be made. LIBOR rates have spiked from their lows in sort of March, April, but LIBOR rates are still relatively low by any historical standard. They're around 50 basis points, a little over 50 basis points, and they've been completely flat since late May. Now what LIBOR is the London Interbank Offered Rate. This is the rate that banks charge one another to loan each other money. Back at the height of the credit crunch back in 2008, that rate was many times what it is now, and that market completely shut down. We really haven't seen that yet. Yes, there have been a real retrenchment in the sales of new corporate bonds, particularly in Europe, but there are a couple different reasons for that. One is that a lot of companies have just come out over the last year with credit markets really strengthening over the last year generally, and have issued a lot of debt, and they don't really need access to the corporate bond market right now. So it's not really necessarily an issue of not being able to access the market. It's just that they don't have any immediate need to, and they're waiting for maybe credit markets to settle down a little bit. The other thing to note is there's been a big difference between the U.S. and Europe. In the U.S., we've seen a number of companies we cover, like Enterprise Products Partners, come out with big bond issue. In Enterprise's case, it was a $2 billion bond issue. The rate that they paid over treasuries is actually lower in late May than it was in late September of 2009. So hardly the sort of disastrous situation ongoing that a lot of people are making it out to be. Yes, Europe will undergo quite a bit of fiscal austerity. This will slow their growth rates. Ultimately, I believe the U.S. will have to pull back on a lot of its fiscal supports and undergo a similar situation, or risk eventually having a credit crunch all of its own. However, I don't think that's necessarily going to send the world back into a double-dip recession. You have to remember that double-dip recessions are actually exceedingly rare. There's only been one in the past 90 years, and that was in 1982. And the reason for that was that the Volcker Fed tightened interest rates very, very aggressively to sort of stick the knife in the back of inflation finally that had been plaguing the markets for much of the 70s. Though we do have some austerity out there, we don't have anything of the degree, an external shock of the degree that we saw back in '82. The fact that economic data in the U.S. has been sort of back and forth and sort of non-committal isn't anything at all unusual. The employment report in June was certainly not a good employment report, but it's not unusual to see a good month and a bad month on that particular report. It's a highly volatile series. Retail sales, same thing. And while a lot of people are focused on those two numbers, how about industrial production up more than expected? How about U.S. oil demand up 8% year over year? How about the fact that the rail car loadings reported weekly by the Association of American Railroads are back at the levels that were seen back before the financial crisis really struck in late 2008. Even in Europe, there's been some decent data out from some of the countries. So I don't really think that we're seeing the major global double dip scenario that a lot of the bears are talking about. I think that what we really saw was the market really went up almost uninterrupted for basically a year and 2 months. And now we're seeing a pullback, a lot of profit taking, a lot of nervousness, and a growth scare. But I really don't expect this to turn into a new bear market. I would not at all be surprised to see a summer rally here over the next few months. It'll probably take us back up to as high as the 1170 area. And then I would not be at all surprised to see a renewed decline into the autumn months, traditionally a seasonally weak time of year for the markets. Still a lot of overhanging nervousness about Europe. Wouldn't surprise me at all. But by the end of the year, I do think the S&P and the other major indices will close higher on the year. Now the other big question is, how do we play that? How do we play this ongoing cyclical recovery story and also the fact that growth is likely to slow down? One of the things I like to do is look at what sectors really outperform the broader market in weak or flat markets. One sector that fits that bill is technology. Unlike the S&P, the NASDAQ never really retested that February low. And while the S&P came back down and actually undercut its late May low in June, the NASDAQ did not. Those are both very, very good signs. Technology is an area that has been showing a lot of growth. We like for fundamental reasons as well. One of them being the fact that a lot of companies did not upgrade their systems over the last few years and are now going to have to upgrade. For example, if you look at the switches and routing market, basically the guts of the internet, the guts of global networking, there are going to have to be a lot of upgrades to handle all the increased traffic that we're seeing worldwide. And that's going to benefit companies like Cisco that sell into that market. So enterprise technology spending continues to be very, very strong, and I think is an area that's going to perform well. Another one is energy. Short term, energy prices down because there are concerns about global growth. However, it's interesting that oil couldn't take out that $65 level, bounce back strongly into the upper 70s. We are seeing strong year-over-year growth in U.S. oil demand. At the same time, Macondo means lower production in the U.S. We're seeing the likelihood that OPEC will have to step in and step up their production by the end of the year. That's actually very bullish for oil because it means their spare capacity to produce is going to fall. So I think energy could be a big area. Another thing to look at, natural gas. While there's a moratorium on offshore drilling, a lot of focus is turning to the onshore. A lot of these natural gas plays are very profitable even at current prices because there's a lot of natural gas liquids which are more oil-like in their price that are produced along with the natural gas. So a number of plays there. Another sector to look at is the industrials. As I mentioned, industrial production in the U.S. was up more than expected in May. We're seeing pretty much that across the board. A number of companies in this area, kind of a cyclical industry, but certainly benefits from an uptick in global manufacturing. These stocks have pulled back along with the broader market. But really, over a year-over-year basis, they're performing a lot better than the broader market, and I think that's another sector to keep an eye on. If you're looking for defense, keep an eye on groups like the Master Limited Partnerships that offer high income, don't have a lot of commodity exposure, and don't have a lot of exposure to broader economic conditions. Companies like Enterprise Product Partners, very solid, quarter after quarter after quarter of increasing their distribution, and also some tax advantages which are going to come to the forefront as the Bush tax cuts on dividends, a special rate on dividends, expires at the end of the year. Thank you very much.